Topic focuses on early warning indicators, EWIs, used in liquidity risk management to identify potential funding and market liquidity problems before they escalate into serious financial distress. Financial institutions operate in environments where liquidity conditions can deteriorate rapidly due to market uncertainty, declining confidence, or systemic disruptions. Early warning indicators provide risk managers with timely signals that allow corrective actions to be implemented before liquidity shortages threaten operations or solvency. The topic emphasizes that effective liquidity monitoring requires both quantitative and qualitative indicators covering internal operations, market conditions, funding stability, and macroeconomic developments. Institutions that identify warning signs early are better positioned to preserve liquidity resilience during stressed conditions. A major category of EWIs involves internal liquidity and balance sheet indicators that reveal emerging funding pressures within the institution. Examples include rapid growth in asset concentrations, increased reliance on short-term wholesale funding, declining cash reserves, and rising maturity mismatches between assets and liabilities. Risk managers also monitor utilization rates of credit lines, collateral availability, and trends in customer deposit withdrawals. Deterioration in these indicators may signal growing liquidity vulnerability even before external markets react. The topic explains that institutions should establish predefined thresholds and escalation procedures for these indicators to ensure management responds promptly when liquidity risks begin to increase beyond acceptable tolerance levels. The topic also highlights the importance of market-based early warning indicators because liquidity stress often becomes visible first through changing market conditions. These indicators include widening credit spreads, increasing interbank borrowing costs, falling equity prices, declining bond prices, rising credit default swap spreads, and abnormal volatility in funding markets. Deteriorating market sentiment can quickly reduce investor confidence and restrict access to financing sources. Institutions must therefore monitor market liquidity conditions continuously to identify potential disruptions early. The topic stresses that market indicators are especially valuable because they provide forward-looking information reflecting investor perceptions about financial strength, funding stability, and broader economic uncertainty. Another important aspect of liquidity risk monitoring involves qualitative and external indicators that may not appear directly in financial ratios but still provide significant warning signals. Credit rating downgrades, adverse media coverage, legal disputes, operational failures, governance concerns, and regulatory investigations can damage market confidence and accelerate liquidity pressures. Macroeconomic indicators such as economic slowdowns, tightening monetary policy, declining asset prices, or geopolitical instability may also contribute to system-wide liquidity stress. The topic explains that liquidity crises are often driven by confidence deterioration rather than purely numerical financial weaknesses. Consequently, institutions must integrate qualitative assessments into comprehensive liquidity surveillance frameworks alongside traditional quantitative measures. The topic concludes by emphasizing the importance of integrating early warning indicators into a broader liquidity risk management framework supported by governance, stress testing, and contingency planning. Institutions should establish clear reporting structures, escalation protocols, and predefined management actions linked to warning thresholds. Effective contingency funding plans enable firms to respond rapidly by securing alternative funding, reducing exposures, or liquidating assets strategically before conditions worsen. Regulators increasingly expect institutions to maintain sophisticated monitoring systems capable of identifying emerging liquidity stress across both firm-specific and systemic dimensions. Ultimately, early warning indicators strengthen institutional resilience by allowing proactive intervention, reducing panic-driven responses, and supporting stability during periods of financial uncertainty.